again. So this part will be about part 2 of lecture 9, auditing the inventory. So remember, so auditing every part actually follows the same principle. So you are going to do some risk assessment, design your audit strategy, and you are going to do some test controls, and also to get the detailed evidence of those accounts, those transactions, of those area, you need to also do the substantive test on the balances, on the transactions, and also on the analytical procedures and on the disclosures. Okay. So if you have a very, very good memory, you can actually memorize the audit procedures, the test control and substantive audit procedures on each assertion in different accounts. That is doable. But remember, in your audit, sometimes you assessed account at risk and also control at risk might be different. So that also means, so when you are designing your audit test, so your decided final test could also be different. Okay, so that's where you need the professional judgment. You need to be experienced as an auditor. So let's talk about auditing inventory here. And I try to make this part maybe short, I think, because this part is almost covered already in the sales and purchase cycle. Is that right? So inventory. Let's think about inventory. Still thinking you are auditing a very, very small company. So in this company, you have designed your audit test for the sales cycle. You also have designed your audit test for the purchase cycle in the last 2 lectures, right? So when you're testing the sales, when you're testing the purchase, actually the item in, item out will be about the inventory changes. So by auditing the sales, by auditing the purchase, you have already got a lot of evidence about inventory. So inventory, auditing inventory has already been done in auditing the sales, partially done in auditing sales, auditing purchases. So here in this part, we talk something beyond the sales and purchase cycle. And also what we need to know is for inventory account, usually this account is material. Okay. So why inventory account is often important, is often material, because it is significant in determining the income. Inventory tends to be very, very high volume, and some of the, actually the inventory valuation process also tends to be quite complex. Inventory exists in the accounting book and also existed physically. So there are a lot of ways to manipulate. So it's subject to manipulation. So that's why inventory account is, after sales purchase, is the 3rd important accounts for the conventional audit. Okay. So just record the inventory management process. So all of us here familiar with inventory management process or not? Taking a very, very simple industry example. So inventory is a part of the production process, right? So when you purchase, you have inventory increased inventory in. When you do the sales, you will have inventory out. So that will be very, very basic, right? But remember, so if the company is, for example, if it's a manufacturing company, if the company is doing the manufacturing process, so actually in the process of production, the value of inventory could also increase. Right? So if we look at the inventory management more complex, you will have raw materials, production progress, and all finished goods. Fortunately, in this unit, we don't really consider that in details. We only look at, so we just assume inventory in, inventory out, and is in the same form. All right. However, even though we make it simplified, we still need to consider human resources. So, in the manufacturing process, so human resources should also be counted as overheads for the inventory. So assignment of the direct and indirect labor cost should also be a concern for the practical auditors. So from this picture, what we can conclude is, so look at the inventory management. It's overarching the purchase and also the revenue. Is also relevant to human resources. It could be very complex, but fortunately for the auditors, because we have done purchase and also we could have done very, very thorough revenue audit. So for the inventory audit itself, we can make it relatively simple, right? Okay. So in terms of inventory account, just by using our common sense, what are the assertions, the most material assertions? The primary assertions for inventory would be existence, valuation, and allocation. Would that make sense? So when we talk about inventory items, so the first yearly, okay, so just use our common sense. When you think about any inventory item, so when you want to check it, I guess the first thing you consider is, so the company, so I have that, so where is that, right? So existence of this inventory would always be the first concern. And in auditing, when you're auditing inventory in terms of existence, you think about two types of existence. One is accounting existence. The other is physical existence, right? And also, the accounting and physical existence should be consistent with each other. And also extending the balance accounts consideration to the transaction considerations. So for existence assertion, you should further link that to the occurrence of assertions in the purchase and also in the sales procedures. Another important assertion will be valuation assertion. Why? So for the valuation of inventory in or inventory out, actually the valuation will be easy to be fixed, right? So the selling price and the cost of goods sold value, the recorded cost of goods sold value will be the value. for the inventory out. And the selling price would also be a reference value for the inventory value as well. And for the inventory in, the purchase price, and including other purchase cost, bring in the item into the usable condition would determine the valuation of the inventory in. So actually, the inventory in value or inventory out value are relatively easy to be determined. But why we say inventory valuation is very material, because the valuation of inventory would be much more complex than just the in price or out price, right? And we are going to talk about later, I guess. So when you assess the inherent risk of inventories, there will be some further considerations, likely the completeness, the competition. So because competition will be very highly relevant to the valuation of inventory. Consider if the company is facing very, very high competition in this industry, the inventory value tends to drop, right? Technology changes is also the big concern when we talk about inventory valuation. For example, let's say a very famous example would be I think 20 years ago or 10 years ago, we have Kodak. I bet maybe a lot of you don't remember this company, but Anthony may remember, right? So 20 years ago, that was famous, the film producer. Yeah. So maybe the top 1 or 2 manufacturer in the world. But likely overnight, not overnight, but over 1 year, this company disappeared because the technology change has made this product unusable. It's not useful anymore. Now we use the mobile phone, we use electronic devices to take photos. So no one would use that. So the value for that particular year, I guess, they would have a lot of inventory, but the value just disappear in 1 year from very high value to 0. So technology change would have impact on the inventory value seriously. And also when you think about inventory audit, also think about very small, tiny amount of the inventories. So if the inventory items are very small, actually the problem is it could be easily stolen, right? Because anyone can just put that into the pocket. The example is in the shop, in the supermarket, for example, a candy. So everyone can just put that into the pocket and just getting out of the supermarket. So those small items are susceptible to theft. The other types of items also need your special consideration will be high value items. Remember in one of the lecture example, we talk about the jewelry factory. So the items are high valued. So if it is taken out by one person, so the loss of the company will be significant. And also because inventory is in the middle of sales and purchases, so related party transaction would also be the key consideration in the audit. Actually, related party transaction in every part of audit, if you look at the audit software, they always indicate, so have you considered related party transactions or not? Because related party transaction in all areas would be the area easy to be manipulated, right? We talk about, so inventory has been very complex. Why? Because accounting treatment for inventory tends to be complex. For example, in the inventory recording system, people could use FIFO, LIFO, moving average, or the perpetual inventory, right? And in different territories, maybe the accounting treatment to the inventory would also be different. For example, in Australia, which one we don't really allow?
LIFO.
But in US, which one we don't allow?
I think they use all, but they use LIFO.
Okay, so so one thing is, so if the company is listed in the US and also in Australia, so which accounting treatment actually would be better for us, right?
Well, for Australia, if it was Australian listed, it'd be FIFO, but I would suggest that SEC would overrule the ASX and they'd do it at LIFO.
So if there's a difference based on different countries' accounting standards, what the company should do and how can the auditors audit that, right? And then the other thing about the accounting policy for inventory is the inventory, the value of the inventory could decrease. For example, if the inventory has been obsolete, then the value need to be written down. If the inventory item has no market at all, the value should also be decreased. If the inventory item has been defective, then of course the value should also be adjusted, right? Because we want substance over form. So we actually need to also consider the conditions and marketability of the inventory items. Also, for inventory value, remember, so the fundamental accounting policy is we need to adopt the lower of cost or net realizable value, right? Could you recall that? So what do we mean by the lower of cost?
If you can't realize it for its cost, then you got to be keeping it in the inventory, recording it at net realizable value.
Okay, so which one is lower than you record in that value? But how would you determine the net realizable value?
Current sales for the similar item, what you expect to get it, like under a fire sale type, probably not a fire sale, but yeah, auction type arrangement.
So for all of us, we are very honest. So probably we use a reasonable net realizable value, for example, the selling price. If the selling price has dropped, then we naturally recognize the realizable value has dropped. But if you are auditing a very tricky company, they may give you a very tricky net realizable value. Then as an auditor, how would you determine is this one reasonable or not, right? So we say, okay, so my let's say I got a warehouse, a room of desktop. So the net realizable value, so I purchased that $1,000 each 3 years ago. And now auditor asked me to use the lower of cost or net realizable value. I have the cost there, but I do have a few options for my net realizable value. How can I determine my net realizable value for this desktop? My cousin has a company, has a computer company. So he wrote me a certificate to say, for this type of computer, I can certify the value would be $1,000 each. Is this the proper net realizable value? So
no.
Not, right. So the net realizable value should be from the a reasonable per third party, and should have some stated certified value recognized by the market. And it's something very, very similar to the fair value we learned in the fair value domain, right? So sometimes how to determine the net realizable value would be quite tricky. Okay, so for the inventory audit, so actually the control of inventory partly has been done in the purchase, partly has been done in the sales, but in the middle, for the inventory control, there are particular procedures for inventory control itself, right? The first important part is inventory control system. So especially for large companies, we are using the perpetual inventory system, which is based on the IT system. So the good design, good protection of the perpetual inventory system would be very important to ensure low control risk of inventory management. Then the other thing is the physical control of inventories themselves. So in terms of that, I think the segregation of duties for the inventory management, inventory storage, to be separate from accounting, from the purchase, from receiving would be very important. And also in the physical inventory management itself, physical safeguards of the inventory items would also be important. So also in the inventory control, we also need to know, so for inventory items, some of the inventory items in your warehouse might not be owned by this company. And also, some of your own inventory items might be consigned in other company's warehouse, right? So goods on consignment should also be considered for inventory control. And also in terms of inventory valuation, so the obsolescence, the slow moving, and also the not marketable inventories would also be relevant to the inventory control as well, because it will be finally in relation to how the management account for the value of those inventories. Okay, so let's have a quick look of how do we do the auditing of the inventory. Remember here, our assumption is we have done a lot of inventory auditing on the inventory items in the sales and the purchase procedures. So here we predominantly focus on the inventory itself in accounting and also physical inventory items. So when we are auditing inventory, we predominantly starting from observation. So in the observation of physical inventory, if you feel the company, so by observation, if you feel the company do have a good control and also physical inventory stock take themselves, so probably you could rely on the company's the inventory stock take results as your own evidence. But if you are not confident about the company's physical inventory control and also physical inventory stock take, auditors would like to do their own independent inventory stock take as well. And so in the physical inventory observation or your independent physical inventory examinations, there might be a few things we want to do. First, when we are doing the physical inventory count, no matter it is by the company itself or by the auditors, we want to ensure at this time, so the inventory items are static, so no inventory changes while you are doing the inventory count. No movement of goods during the inventory count. And also in the inventory stock take, the tag system will be very important. So for different categories, different departments, the inventory tags should be very, very clearly labeled. And also the inventory tag in different accounts, different items, different departments should be issued sequentially. So when the person is doing the inventory test counts, so the inventory usually should be for a certain types of inventory, it should be, the inventory test count should be done from wall to wall, should be very thorough. And for the other types of inventory, so you probably could choose the samples. So which item you choose to do the wall-to-wall check, which samples you want to do the very small sample check is actually based on your experience. So what type of inventory usually would be, put into the special samples? For example, the inventory item, which is very big value. So you check the big items in your inventory list. For those items, you need to cite them one by one, right? For example, inventory items of high risk. So for example, we often say auditing the inventory, especially for the agriculture industry, sometimes would be very, very problematic. So like you are auditing the farm. The farm told you, I have 10,000 pieces of cattle. So, and then what you could do is to count the cattle one by one, right? But you couldn't count 10,000 cattle one by one without any stop. And you couldn't put 10,000 cattle into one, let's say, one field or one warehouse at the same time. So what you usually do is you have cattle in this farmland, cattle in the other farmland, cattle in another farmland, and count them gradually. But there will be a lot of risk there. For example, if the farm owner really wants to trick you, while you move from farm A to farm B, they could also move their cattle. So you do have the risk to count them twice, right? So in that situation, so physical inventory count would be, sometimes could be very simple, but actually will be a lot of risk. In our guest lecture recordings by Mark Sheraton earlier last year, Mark has given us a lot of live examples. How did he do the inventory stock take? How did he audit inventory? And I will post the recordings into the learning materials, so you could listen to that to get more practical insights. So when we are doing the physical inventory stock take, back into this page, so when we are finish our test counting, we should also observe the conditions of the inventory items. Are they in good conditions? So what are the signals of not good conditions? For example, they have a very dirty cover. For example, so the item itself has been broken. So when you are doing your physical inventory stock take, actually, we should also watch out the conditions of inventory items. And also, when you are doing the physical inventory stock take, a few important things should always bear in mind. For example, you are still auditing a lot of desktop in the boxes, right? So occasionally, actually, irregularly, you might want to lift the box because the box might be empty, right? For example, we are auditing a fish shop. So they do have the fish valued at, let's say, $10,000 per ton. But that value is based on good quality fish. What about the fish are not in good quality? So probably you like to step into the warehouse, open up the fridge, and also check the quality of the items. Not all of them, but occasionally, right? And also, when we are doing the physical stock takes, sometimes the items might be placed in different places. So for you, how would you ensure they don't really move the item from one place to the other place while you move to do your physical inventory stock takes? Those would also be something you should take into your consideration. And also in the physical inventory stock take, you should always inquire the management. So are the goods held, do you really have the ownership to those goods? Are they the goods on a consignment from others, or do you also have goods on consignment for others as well? So yearly, just tick the box for this question. In the inventory stock take, we should also do the substantive analytical procedures. So in that part, we also have a few important ratios or numbers you should watch out. One thing is inventory turnover. As we learned from lecture 5 or lecture 4, so inventory turnover or days inventory would indicate slow moving or obsolete inventory items. But when we go to the inventory auditing in this special area, so your analysis shouldn't just about the overall inventory turnover. You should detail the analysis into categories, classes of inventories, because different inventories would have different turnover period. And also, I think gross profit, this percentage actually would also indicate a lot of information. So if the company has a very, very high gross profit, for example, compared to the industry, what is the implication? It might implicate, so they have unreal sales as we suspected in auditing the sales, right? They may also indicate they have understated. They may have understated cost of goods sold. So that will be relevant to your inventory value. So like fictitious inventory, etc. And so when we are doing any types of inventory analysis, remember, we need to analyze that in line of different products, in line of different industry, in different categories. So we shouldn't do the overall analysis. We shouldn't restrict us to the overall analysis. We need to do that in more details. So we say for cutoff test in sales and purchases are very important. So those testing results will also be brought in our consideration for auditing the inventory. So at the same time, the inventory itself would also have the cutoff test. So from the beginning of the year and also by the end of the year. So at the cutoff times, what is the carrying amount of the inventories, what has been the ending balance for the inventories should be determined very accurately. And also any book to physical. So we need to compare the beginning inventory, ending inventory items, and then compare those values with the sales and purchase testing results. So if there's any differences, so you need to follow up. The other thing about the cutoff test is, so there might be differences from the book value to the physical value. So when there are book to physical differences, we should also further investigate, because it may indicate the cutoff errors, but also more likely indicate problems in the company's inventory written off or the possible fraud in the inventory management. In terms of the valuation assertion, so of course, when we are doing the physical inventory, we look for obsolete and damaged items. We look also, so it gives us indication of the value of the inventory. When we are doing the analytical procedures, it also indicates potentially obsolete or slow-moving items, also give us indirect evidence for the value, right? And you should always ask the management. So how would you determine the value of the inventory? Have you fully considered the obsolete or slow-moving items when you calculate the value to the inventories? And management should be able to give you reasonable explanations. And also for valuation, your proper calculation and inspection to the documents, of course, will also be a part of the test, right? And to determine the net realizable value. So at least the recorded net realizable value should be lower than the subsequent selling price. That will be the bottom line, right? Okay, so these are the detailed audit tests for the assertions to inventory as extracted from the textbook. So I just put it here and for you to review after the class. So as I mentioned, so for all different blocks of audit, so actually for assertion, there will be standardized auditing procedures. So what we want to practice is to identify the key accounts, key assertions, and also to differentiate the different levels of audit risk. Therefore, to differentiate the level of test. So by doing that, you can further determine, so from the optional testing procedures, do you need all of them? Or maybe you can only do a part of that, and that will be sufficient, appropriate for your targeted company. Okay. So in terms of, so I just leave those 2 pages for you to read of the class. And also in terms of disclosure for auditing the inventory, remember, so from initial, what we usually focus on, existence of inventory, second, valuation of inventory. So actually in the inventory disclosure, they also focus on those. For example, you need to disclose plate inventory and warranty obligations, which is about rights obligations, but also further link to those hidden information for the existence assertion, right? And also for the costing methods, for example, lower of cost of net realizable value, and how do they conduct the complex inventory stock take, etc. All of those would also closely relevant to the valuation assertions. And if the company do have a complex manufacturing procedures, so the raw materials, work in progress, and finished goods classifications would also be very, very important for this company. So this should also be disclosed. Okay. So I guess that's almost all for auditing the inventory. So as we have done in auditing sales, auditing inventory, auditing purchases, after you collecting all the evidence from test of control and also substantive test, you should make a conclusion that is based on the detected misstatements. If the detected misstatement is lower than the tolerable value, so the result is okay. You could just safely say, so the account is fairly presented. If the detected misstatement is higher than the tolerable level, then you should report, actually you should communicate the management for them to make correction. If they couldn't, if after correction, the misstatement is still bigger than the tolerable value, then the account would be labeled as not fairly presented. Okay. So I leave the lecture example here for you to consider, and I'm going to cover that in next week's tutorial. Thank you. Thank you. So, so if you are doing the presentation in 8 p.m. tutorial, please stay in this room, but I'm going to leave for 1 minute and coming back to make the recordings saved. Okay, so see you very soon. Thank you very much.